Did the stock of Signet Jewelers deserve to lose 15% of its value today? Going into the quarter, this stock was up more than 80% over the past year, thanks to recovery in engagement ring sales, which finally started bouncing back from the pandemic. But this morning, Signet reported 26-cent earnings beat off of an 85-cent basis, paired with slightly weaker than expected sales, but then gave lackluster guidance for the current quarter. Plus, management left their full-year forecast unchanged, which implies the rest of the year is not so hot, because they just reported a sizable earnings beat. In response, that's why the stock plunged 15%. Could it be an overreaction? Or do we need to get a little more worried than I have been for some time about this stock? Let's check in with Gina Drosos. She's the CEO of Signet Jewelers to get a better read on the quarter. Gina, welcome back to Mad Money.
Hi, Jim. Thanks for having me.
Oh, it's great that you're here. You can shed some light on things because there's this kind of like a valley of the shadow of death, then snapback thing you're predicting. This quarter good, then a little bit dip, and then don't worry because the second half will be great. And I just need a little more confidence because I know last time the stock got hit and it just then soared. I'm wondering if the same thing can't happen again.
Well, I think the key message on the quarter, Jim, is momentum. All of retail saw a sluggish start to the first quarter in February, but we began to rebound after Valentine's Day. We saw that continue through March and April with an even stronger May. We're still holding our increased full-year guide. We raised that in April, 9 to 10% on EPS, and that guide includes our belief that the business will inflect to positive same-store sales growth in the back half.
Well, if that happens and you do what you talked about, or your CFO talked about, which is possibly buy in all your preferred, you have a lot of firepower beyond that. This may be in a situation where, like, a week from now, you can say, look, we're going to do all these different things because we have excess cash, and earnings per share may turn out to be light. That could happen, right? Your forecast could be lower than what would happen if you bought back the preferred.
Well, we definitely have cash on hand to buy back the preferred. As you know, cash has been a very strong story for Signet. Our balance sheet is healthy. Our working capital is healthy. We've generated free cash flow over $600 million each of the last 4 years. We've reduced our debt by 70% versus pre-pandemic, and we have the cash available to be able to take out the preferreds, which it's our intention to do before the maturity date.
All right, good. I don't want to get too stuck in the weeds, but I want people to know that this may be a short-term blip down because of the way that you can that you have the financial firepower to take care of things. Now, I do want to get into this notion of the what you actually called the heightened competitive discounting in jewelry. Now, when did that start happening?
Well, we've seen independent jewelers be over-inventoried. So, you know, a lot of the impacts of COVID were pretty easy to predict. One that wasn't as obvious was that because of lockdown, people would stop dating. And so therefore, multi-years later, 3 to 4 years later, we would see a lull in the number of engagements. Our data analytics, our consumer insights are proprietary, and we did predict that. That's why our inventory has been so healthy, but a lot of the industry didn't. So for the last year, independent jewelers have been over-inventoried, and the level of discounting has been significant. Now, that said, we have a number of strategies to mitigate that kind of pressure on our business. One is to bring significantly more newness to our business. We've done that in both bridal and in fashion. And I talked on our call today about how we've seen engagement unit trend go up by 400 basis points in the quarter. And we've seen the fashion same-store sales go up. That trend has changed by 500 basis points over the last 3 months. So we're seeing broad-based momentum in the business based on that strategy of newness. Not only that, we also now have a loyalty program so that we can target our value propositions to customers better as opposed to making them broad scale. And our services business is a fantastic offering that's also a high margin business for us.
Okay, how much of your revenues is the extended service plan?
Well, we don't talk about percentages of the revenue, but what I can tell you is that it's a fantastic add-on purchase for people who are buying engagement rings or higher priced fashion. In fact, 80% of the time that we sell an engagement ring in store, someone purchases our extended service plan because it offers a great value to our customers.
But at the same time, if I want to be able to get a lab-created diamond, I probably don't necessarily want that service plan.
Well, we're not really seeing consumers distinguish that way. The service plan covers much more than just the diamond. So a tightening of prongs, if you want to, go in and have the diamonds checked to make sure that they're fitting exactly right. Resizing is something that our service plan would take care of. So these are things that consumers are interested in, whether they buy a natural diamond or a lab-created diamond.
So a lab-created diamond, let's say it's great, they've grown tremendously, so we all want people to have a chance to have a diamond. These are diamonds. Is it good for Signet or bad? They've now taken about 50% of the market.
I think our diamond strategy has been working very effectively. We saw that work very effectively in the first quarter as well. And that is that lab-created diamonds can offer the opportunity for people with a challenge budget to be able to get a larger or stone with a higher color or clarity. In that case, though, we most often see people trade up. So the average transaction value on a lab-created engagement ring is higher for us than on a natural diamond engagement ring. But the really interesting story is in fashion jewelry. We said on our call today that our lab-created fashion jewelry was up 14% in the first quarter at an average transaction value more than double the balance of our fashion merchandise. And so that's a significant opportunity for customers to trade up into something with a bit more bling.
Well, look, I think you're making the best of both worlds. I do think that there was an overreaction today, particularly because you've been such a great steward of the balance sheet, not just the business. I want to thank Gina Drosos, CEO of Signet Jewelry, for coming on. Gina, you always give us a great perspective on everything. Thanks so much for coming on.
Thank you, Jim.
Okay, Mad Money's back after the break.
Coming up, known for major patents, Pfizer has rewarded investors for decades. What's in the pipeline for this household name? Stick with Kramer.